Hello, everyone. Before you listen to this excellent fireside chat with a structured credit expert, I have some rather big news for Forward Guidance listeners. This will actually be one of the final Forward Guidance episodes that I'll be hosting. The extremely talented Felix Javin will be taking over Forward Guidance very shortly, and I'll be leaving to host a new podcast called Monetary Matters. You can subscribe to the Monetary Matters YouTube channel right here, and the Monetary Matters podcast channel will be set up very shortly. And of course, you can stay up to date with my work by following me on Twitter at JackVarley96. Thanks, and let's get into today's interview. Today, we are going to be talking about everything collateralized loan obligations, or CLOs. So if you are a finance nerd like me, I think you're going to find this very interesting. We have another fireside chat with Laila Kollmorgen, CLO Tranche Portfolio Manager for Pinebridge Investments. A maven of structured credit and CLOs, Laila is the portfolio manager of a CLO strategy that VanEck and Pinebridge have launched together. She also manages other CLO strategies at Pinebridge. Laila, welcome to Forward Guidance.
Thank you very much. It's great to be here.
It's great to be with you. Can you explain for our audience what is a collateralized loan obligation?
It goes back to the history of securitization, but ultimately the goal of a CLO or any other type of securitization was to free up bank balance sheet. It was an ability to enhance, back in the early 80s, enhance home ownership by taking mortgages off of the bank balance sheet, pooling them together such that investors, many of them institutional investors, could buy it such that they would be able to earn a nice return. The banks were able to free up some balance sheet and make more mortgages. Well, this type of science actually developed over the years to move away from just residential mortgages to auto loans or to credit card receivables. And banks ultimately said, well, wait a second. We could do this with our below investment grade lending to corporations. So back in the day, it was known as bank loans. And banks used to make loans to corporations so that they could, of course, expand their businesses or maybe do a merger and acquisition or maybe a leverage buyout. And banks used to make these below investment grade loans on a regular basis. In fact, they decided to syndicate them, share the risk. So what they would do is share the risk with other banks. And then institutional investors said, well, wait a second, we want to get involved in this. So they started to purchase the bank loans as well. Well, the bank said, wait a second, we could get even more efficient and we can take some of this off of our balance sheet, which would allow us to make more corporate loans. And so they securitized them into a collateralized loan obligation. Now, the reason that a CLO or any other types of securitization are so attractive is because the underlying collateral has a value. A home has a value. An auto has a value. In the case of a corporate debt, in the case of a leveraged loan, it actually has a value as well. It's not as if you're buying equity in a company, which if it goes bust probably has no value. In fact, because it's a debt that is collateralized by some sort of an obligation from the company, it actually has a pretty high recovery value. So it is known as a first priority debt. So in the case of a bankruptcy, what you find is that a leveraged loan obligation, if it's a first lien, it has a higher recovery rate, and historically that's been between 60 and 70% recovery in the event of a bankruptcy. Now, compared to high yield, which historically has about 25 to 40% recovery rate, that actually looks pretty good. And that's one of the reasons why you take a look at a leveraged loan as the collateral in a collateralized loan obligation, and it actually has value. So in the event of things going wrong, there is a residual value to whatever may go into bankruptcy and makes it an ideal source of collateral in a securitization. And that's what makes CLOs, in fact, such an interesting product because of the very good performance historically over 30 years through the various different debt tranches. We can kind of go into what that looks like. But what it does is that it has very low levels of default, has a very high yield, and a very low loss rate.
Thank you, Laila. And just to frame our conversation, so CLOs have been in a bull market over the past few years for a variety of reasons that we'll get into. And much of the CLO world has rallied tremendously. And just from reading your work, I think you think what we're facing may be a time where there could be some outperformance for more CLOs. Some do better than others, and there's a chance for CLO managers and investors to choose wisely as the credit cycle evolves. But just to wind back, people, when they hear C blank O, a CDO, a CMO, a CLO, I think some people feel a little bit antsy because collateralized debt obligations were at the heart of the great financial crisis. Could you explain the differences between a collateralized debt obligations and what blew up the entire economy was subprime mortgage bonds that were packaged into CDOs, and how that differs from a collateralized loan obligations where the underlying assets and underlying collateral are loans to companies. And perhaps you can show that difference by just how well CLOs performed relative to CDOs. Like they went through the worst, great financial crisis ever, other than the Great Depression, and performed much better than CDOs. Why is that? Is it just that the bubble was in subprime, it wasn't in corporate lending, or are there other structural reasons?
It has to do with twofold. First of all, we have a very simple saying, garbage in, garbage out. So that's the case of what happened in ABS CDOs. What we found with subprime, because subprime mortgages were originated, there was no real mortgage regulation. You had people that lied, so hence the term liar loans, became prevalent. And when you have mortgages where you think that again, it comes down to what is the real recovery value in that mortgage? And if that is not an 80% LTV, it turns out that it's much, much less, that value of that home. That's really what it comes down to. What happens when things go wrong? What is that recovery value? So what happened is there were a variety of unfortunate incentives along the way from people who were able to originate mortgages that were liar loans. They were incentivized in a certain way to do so. They were compensated with bonuses, so they just kept originating mortgages, unfortunately, to people who never should have been able to get a mortgage or on multiple properties, and it caused valuations to go up. The problem is it comes back down to the valuation of that house, that mortgage. And when the valuations go bust, it feeds through to everything else. So those mortgages, which were pooled together into a residential mortgage-backed security, theoretically, you're supposed to have a cushion of 20%, say, to an 80% LTV. To most people who go and get a mortgage, their mortgage bank typically looks at them and says, we need 20% down, maybe 25%, depending on the kind of mortgage you get. Subprime, the issue is that you have borrowers historically who don't have great credit. So it's not so maybe they have to pay more. So there's certain little aspects about those mortgages which are known as non-conforming mortgages. And as a result, when you pull a whole lot of these together, it should, in general, in aggregate, be okay, because not all of them are going to go bad all at once. Oh, except they did. When you have a small amount go, that's kind of built in to the expectations of default and losses. However, when you have it go and a large swath go wrong, that's your problem. So when you then take all the mortgages going poorly, that means the RMBS, the residential mortgage-backed security, does poorly. And if the RMBS has been pooled together with many other RMBS transactions into a collateralized debt obligation, that's your problem. Your garbage in becomes your garbage out. And that's what you have that one level of default and which is across a large swath of subprime mortgages, feeding into levels of default in your RMBS, which led into levels of default in your CDO. So it always comes back down to the collateral. And so in the case of subprime, very different. We know what the issue was, lack of market regulation. Again, when we take a look at the leveraged loan market, again, these are loans made to large corporations that are not investment grade in the United States principally. Principally, United States, Western Europe, Canada. That's where these loans are made. They used to be made and held on the bank balance sheet of all the banks you know. You have Bank of America, Goldman Sachs, Morgan Stanley, Merrill Lynch, Chase, JP Morgan, everybody. But because of the GFC, exactly what you pointed out, it showed that there was some glaring disincentives at the investment banks because they had bought mortgage originators. They earned fees on originating the mortgages. They earned fees on securitizing those mortgages into RMBS deals. They earned fees on taking those RMBS deals and putting them into CDOs. So they created a vertical. And the problem is that they kind of shot themselves in the foot. And the regulators came in, looked at banks and said, wait a second, you know, we don't think your risk management is doing a really good job in managing risk, and you have too many disincentives along the way. So we're going to go ahead and make sure that these banks, which are very large, don't become a systemic risk to the system. And as a result, we're not going to allow you to hold below investment grade debt on your balance sheet unless you hold a lot of capital against it. As a result, since the GFC, investment banks don't hold below investment grade debt on their balance sheet. They literally syndicate it. That means it's purchased by institutional investors, principally in the United States and Western Europe, but around the world. It is also purchased by CLOs. So you have CLO managers who are taking these loans, and each loan, leverage loan, is analyzed by hundreds of institutions, credit analysts, and they are independently determining the worthiness of that company credit. And that's very, very different than taking a look at what happened in the GFC and a subprime mortgage. You had one set of eyes that was originating that mortgage. Theoretically, maybe you had some oversight, but in reality, you didn't. You had one set of eyes on who was actually originating that mortgage. In the contrast with a leveraged loan, you have hundreds of institutional investors who are independently analyzing and determining the credit worthiness of lending to a company. I think that's a major, major difference. It's the underlying collateral and the value of that collateral, but it's also about the origination process and the syndication process. So who is taking a look at the various different types of debt and how they're determining the risk associated with it. So I think these are very different types of origination on debt, and again, very different types of ultimately the investor base when it comes down to the collateral.
Thank you. And so, yeah, both CDOs and CLOs, they issue liabilities to investors, and the assets are they owned collateral. In the case of CDOs or mortgage-backed securities, it's subprime mortgages. In the case of CLOs, it's corporate loans. So you have that balance and the structure, and then the earnings, the income, the coupons from the loans go to pay the liability holders, the debt holders, and then there's also an equity tranche. So the fundamental difference is business loans to companies are a much higher credit than mortgages to people who are not being honest about their income when there's a giant mortgage bubble. Is there also a structural difference between the reinvestment period where some CDOs had collateral triggers where there were kind of fire sales, when in CLOs there is no bank run because the liabilities are matched?
There was known as market value CDOs. I think that you're referring to market value CDOs, and that was indeed was it was meant to be actually a protection. That was why it was, um, you know, instituted. Unfortunately, the market moved too fast, so a lot of the market value deals blew through their triggers, and it became kind of a negative situation. You were chasing the market down, and therefore it didn't actually end up acting as a protection to the note holders, the most senior note holders. In fact, it in fact worked in the exact opposite direction. So I think the thing to keep in mind, and I always say this, it comes down to the collateral. When you're talking about liar loans and you're talking about false data, there's not much you can do about it. Fraud is fraud. But when you're taking a look at a market like, a bank loan, a leverage loan, you're not you don't have this one set of eyes or maybe two sets of eyes that we're taking a look at the validity, at the quality, let's say, of that mortgage. This was the problem. The investment bank originated the mortgage, they securitized it. They were the one set of eyes. In the case of a CLO, It's the fact that your collateral, in fact, is vetted by hundreds of institutional investors, professional institutional investors. And I think that's the huge, huge difference, is that level of just from the basic level. It's two different types of collateral, and there is the validation, external validation, that's so important, that makes it, that big difference. One set of eyes, two set of eyes, all within the same company, or hundreds of institutional investors who are telling you, it's okay to lend to Staples, for example. It's okay to lend to Fogo de Chão. It's okay to lend to Burger King. It's not just you and your boss who's making the decision to lend.
Collateralized loan obligations. I mean, I'm just looking at an index that you're not managing. VanEck does not manage, but just a broad passive index of CLOs, and that since like January 1st, 2022, is up a little over 20% from now. And over that same time period, a lot of fixed income investors have been absolutely destroyed by duration, by interest rate risk, because interest rates have gone up. There was a lot of inflation. So if you held agency mortgage-backed securities or long-term treasuries, you just basically got obliterated. Meanwhile, CLOs, which take much, much less duration risk, they take more credit risk, they've performed well. So just, what's it been like being in a space when a lot of the fixed income world has really taken it on the chin, whereas your sector has been performing quite well?
The data point that we like to point out is that of the last 11 years, CLOs have been the best performing fixed income asset class in 8 of 11 years. It's surprising to many, but we say that it's an institutional asset class. And it's only through some changes in regulation. So we've been able to now finally have ETFs in CLOs. And that has really only been in the past 3 years. We launched the ETF with VanEck in June of 2022. And as you very well know, 2022 was an absolutely dismal year for fixed income. CLOs were the only asset class that returned a positive that year. And that is because it is floating rate. So certainly we were taking advantage of the fact that the Federal Reserve was increasing interest rates. We are a floating rate product. As a result, we were also trading at a spread to the increases in the index. It was changing from LIBOR to SOFR at that time. We made that transition, to the new index. And as it stands, I think when we're taking a look at performance again through 2023, we also found that CLOs continued to outperform, and that really was due to the below investment grade tranches. And again, through 2024, we're still taking a look at outperformance, mainly through the below investment grade tranches. That said, we haven't had to deal with the duration uncertainty that you mentioned. Investment grade, the ag, high yield, mortgages, treasuries have all had massive levels of volatility. That's what has led to severe underperformance for those portfolios that were predominantly invested into fixed coupon sectors. And as a result, when we are talking to so many different investors, they didn't have enough exposure to floating rate. They didn't have any exposure to CLOs. And what we saw is that their portfolios took severe hits. And we have demonstrated that if they had an allocation of 10 or 20% to CLOs, two things happen. First, they're able to increase the yield on their portfolios. They're able to, secondly, reduce duration in their portfolios. And thirdly, they are able to increase their Sharpe ratios. So Sharpe ratio has to do with your level of return per unit level of volatility. So it's one of these measures a lot of people take a look at to say, well, how risky is this? And CLOs have, in investment grade CLO tranches, have the highest Sharpe ratio when you compare it versus investment grade, high yield, even leverage loans, any type of fixed income asset class. What you find is that CLOs, in investment grade CLOs in particular, have the highest Sharpe ratio compared to any of those other fixed income sectors.
And a Sharpe ratio is basically unit of return per unit of risk or unit of volatility. And that can be observed just by looking at a CLO index. It's almost like a straight line, or as close to a straight line as you're going to see in finance. And so it's kind of like it's going up every day. Why is it the case that it's going up every day? And let's say there's a collection of bonds, high yield bonds, even treasuries that have returned the same as CLO index, but they've done so over a much choppier path. So if you could hold on and you don't care about volatility, they would have returned the same thing. But a lot of people do care about volatility. So the better performing one on a volatility adjusted basis would be the CLOs. Why is it that in the topsy-turvy world of high yield, money comes in, money comes out, but in CLOs, it's been extremely unusually calm weather? Why is that the case?
It's twofold. It has to do with how CLOs are structured. So, as we mentioned at the beginning of the call, it's a securitization, which means that you have what's known as a capital stack. So we start at the top with triple A's, below that's double A's, below that's single A's, below that's triple B. So those are the investment grade tranches. And then we get to a double B tranche, and occasionally we see a single B, and then we have what's known as an equity or residual. But it means that a CLO, if that underlying portfolio has any losses, it's applied to the equity tranche. If things go badly for whatever reason, there's a lot of tests, performance and quality tests that a CLO manager must pass. And if they don't pass for whatever reason, payments made to the more junior tranches go to repay the senior tranche. Now, because of the way this works, it does mean that you have what's known as subordination. So we call it cushion, credit enhancement. And let's just take a look at the double B tranche. So you have approximately 11 to 12% subordination below the double B tranche. And what this means is that your CLO can, in fact, withstand a significant amount of defaults and losses before you would ever get any losses at a double B tranche. And that's a minimum, let's say, that 11%. We can, as I mentioned, CLOs or leveraged loans have a recovery rate of 60 to 70%. If we assume something more like 50%, just because it's an easy number, that credit enhancement itself means that you could withstand 22% of your portfolio defaulting before you would have any dollar loss. That's a huge amount. It means that you've got somebody or something catastrophic has happened. And that's not even including what's known as excess spread, which tends to be between 12 and 15% per annum. So in reality, you can have a significant amount of defaults and losses before you would ever hit any of the debt tranches. So let's call it 40% at a 50% recovery. It's a huge amount, and it's something that you have to keep in mind when you're looking at, why is it that CLOs have performed so well, and why is it that they haven't had that very high level of volatility? It is because of two things. One is the fact they're floating rate. The second has to do with the types of investors that purchase CLOs, particularly the investment grade tranches. Those tend to be banks and insurance companies around the world. Those are by far the highest level of investor base in those tranches. And the last happens to do with the fact that so you've got this investor base which has a very strong allocation, to investment grade tranches, but it also has to do with just the historical performance. So you do have pension funds in the triple B and the double B and in the equity tranche. You have asset managers, you have family offices. They invest into all of the lower rated tranches because of the high levels of current income as well as historical performance. So we find that overall, that level of volatility is mostly felt in, I would say, the triple B and below tranches, but really the below investment grade tranches. And the more senior tranches don't have that level of volatility because, in part, because of the investor base, and partly because of the floating rate nature of the asset class.
If I'm trying to paint a picture about why collateralized loan obligations have performed so well. Part of it, perhaps you would say, is the virtue of the structure, the virtue of the over collateralization. Part of it is the fact that fixed income investors, giant institutional firms, banks, insurance funds, pension funds, have just been burned so badly on interest rate exposure. I think of Bank of America, which has literally $500 billion of securities that have lost enormous amounts of value as interest rates have risen. If they had invested in CLOs, of course, hindsight is 2020. They would have done a lot better. You have made the
Believe it or
point.
not, they actually do.
What do you say?
They do actually.
Invest in CLOs.
They do.
Oh yes.
They are one of the largest U.S. investors in CLOs.
Yes. They also are a huge investor in like long duration paper too. Yes.
Yeah, their investments really showed that, when we take a look at their bank holdings, it's quite evident. They could have done more in CLOs. But as you point out, there were also banks that didn't do any CLOs,
Yes.
and that's the real issue.
Do you want to make the point about Silicon Valley Bank? I'll let you make the
Sure.
point.
So Silicon Valley Bank, really epitomized how there were banks that really, and unfortunately, it comes back down to the GFC in large part, but the regulations incentivize banks to hold U.S. Treasuries, to hold mortgage-backed securities, because you get a 0% risk rating charge against it. And as a result, they are incentivized to do so. And when you take a look at what Yellen was saying at the time that Silicon Valley Bank happened, she was saying it's a mark-to-market issue. It's not a credit issue, which is absolutely accurate. But when you're taking a look at your own portfolio, whether it's a bank portfolio or whether it's your own portfolio and it's a fixed, coupon in investment and interest rates have risen, okay, that is the math. The price goes down when interest rates go up. The problem is that not enough of the Treasury departments were taking a look at investing into asset-backed securities and into CLOs. And when we take a look at CLOs, those banks that had investments in CLOs did not have that same level of mark-to-market losses. Again, not credit issue, mark-to-market, because that's the math. And as a result, those who did have higher exposure to CLOs in particular did very well. And to make this point a little differently, when I meet with the UK pension funds, so there was the UK LDI crisis when you had Liz Truss government happen. What UK pension funds do is that they have a significant allocation to CLOs because it is liquid. And when they needed to raise cash, they went for their most liquid, highest priced assets, which were AAA and AA CLOs. And they sold out of those. And the market, sure, it traded off a bit. But as soon as they were done raising the cash they needed to, the market came back in CLOs. It's just a demonstration of when you need liquidity, when you have market, downturns. Many market participants turn to CLOs because of the fact they are so high quality, in demand, have a high price because they're floating rate in nature, and this allows you to raise cash. We do this at Pinebridge across all of our strategies, across our opportunistic credit strategies, multi-asset strategies, etc. So we use this the same way as the UK pension funds do, and banks, also as part of their own risk management and part of their own treasury functions, and not just banks, but we see this also at corporations, invest in CLOs for that very same reason. Now, just because it's out there doesn't mean it's done. And that's where you have Silicon Valley Bank and other similar banks that didn't invest in CLOs, did not have a true, appropriately diversified investment portfolio. And as a result, it really took them down when things went against them.
You mentioned Yellen's point about it wasn't a credit issue, it was a mark-to-market issue. Absolutely correct that it was not a credit issue. Of course, Fannie Mae is going to pay you back, but the mark-to-market, saying it's mark-to-market makes it sound like you bought it at 100, the true value is still at 100, but it's a fire sale, so people are panicking, so the best bid you can get is at 94. But actually, I think you bought it at 100, the economic value of it went to 85 because interest
Yeah,
rates went up, and
that's right.
you can no longer pay your depositors 0%. And I think that loss is real. And yes, of course, hindsight is 2020. But if everyone invested in floating rates security CLOs and took more credit risk and way less duration risk, of course they would have performed better over a time when inflation went to 9%, interest rates was from 0 to 5.3%, and defaults were low. So credit risk did not really materialize that much, and duration risk absolutely was a horrible risk to take. It's important for the audience that the performance of asset classes are dependent on macro regime. So if inflation goes back to 10% and interest rates go to 7%, I think it's a fair bet to say that high yield will probably outperform the 30-year treasury bond. But if we have a recession and interest rates go down, credit risk spreads blow out, CLOs, high yields will likely perform worse than long duration treasuries. So I think the point is to kind of be an asset class for all seasons and be a long-term investor rather than just say, oh, this performed well. And a lot of that was because of this environment. Final point, Layla, before we move on to get it really in the weeds of the CLOs, is can you just talk about the demand for AAA CLO securities? And I mean, you've got a chart from your most recent article on Pinebridge.com, and it's about Norinchukin's bank, and you should just show how much potential the demand could be. Can you just explain a little bit of the work you've done there?
Yeah. So Norinchukin happens to be, one of the most experienced investors in the CLO market. They have been in the market for, at least 30 years. They have been investing. A portion is an agricultural bank in Japan. They have a very large portfolio in CLOs. And so Nora Chukin, in 2021, 2020, they bought just like SVB. They bought treasuries. They bought long dated mortgage back
Mhm.
securities. They bought IG bonds at really really low coupons. And unfortunately, what they found is that it wasn't just enough coupon income given their current needs, which are demanding higher payouts. So they found literally that they needed to sell them because literally the income was just not sufficient. And Norinchukin is selling that quite publicly. It's come out with, in the press that they're going to be selling, those marked market loss making securities, and they're going to be rolling that into CLOs. And very similarly, as we talked about with, the regional banking crisis in the United States, we have found that banks are increasing their exposure to CLOs. Part of that also has to do with changes in regulation. What's known as Basel III Endgame is changing the capital charges for AAA tranches for banks from
Hmm.
20% to 15%. Again, because of the very good performance. No AAA nor AA security has ever defaulted or lost money. So when you put that in combination with highly regulated entities such as insurance companies and banks, they're looking at CLOs, given the very high Sharpe ratio and the incredible performance. Once again, they're saying there is nothing better that we would like more of. And as a result, Norinchukin is selling its loss making investments and putting it into CLOs. When Norinchukin does that, you know that other entities in the region will also be doing the same. We also know from, again, because of the Basel III endgame changes, increased demand will also come from European and banks around the world. Basel III endgame regulations get mirrored ultimately in its own format in the United States. Given what happened with regional banking crisis, we again see demand for AAA and AA CLOs from the US banks. Then we take a look at that performance changes in insurance company demand as well. Again, insurance companies around the world, there is absolutely nothing better than CLOs. Investment grade CLOs for insurance companies, long-term investment books, whether it's a property and casualty or a life insurance company, putting that investment into CLOs has proven very good. We have found again across the different types of institutional investors, pension funds, again continue to increase their allocations to CLOs. And again, what we find with family offices, et cetera. So then you have that demand, everybody taking a look and saying, what worked over the last few years and what didn't? CLOs worked. So even if you just move a portion of your portfolio 10, 20% into CLOs, you're getting a higher yield, you're getting less volatility, and a higher Sharpe ratio. And that's making a lot of asset allocators really, really happy and making their headaches go away. So that's really important. And this launch of ETFs, that's the other thing. So as we take a look at ETFs opening up, finally, CLOs, which has been an institutional market for decades, to retail investors, that is huge. A large part of this has been education, making that differentiation that a CLO is not an ABS CDO, has nothing to do with US subprime. There is a reason why the performance has been very, very different over the last few decades, and why it's been much better, and why it should be considered for ETFs. And through this, education, what we have found is it's a little bit of disbelief at the beginning. Why does this look so good? is without a doubt a large part of the response that we get when we go through the education. But it comes down to the structure, it comes down to the collateral, and then ultimately it does come down to people like myself and my team here at Pinebridge and what it is we're doing. Which are the CLOs that we're selecting? Because there are differences. You can't just buy a AAA. We know that. You can't just buy a double A or a single A or a triple B. You, in fact, can add value to the portfolios that are constructed, and you can, in fact, add value through security selection. So it's a little bit more than just buying a rating or just buying CLOs at a particular rating. I think it's important to also understand that there are some variations, in the investment process as well.
So we're at this point where CLOs have rallied so much. I just want to read a few statistics for our audience that the average price from your paper, the average price of AAA to triple B rated CLOs is now above par, with prices for these portions of the capital stack in the 97th percentile or higher relative price to prices over the past 5 years. So some of the CLO world, a lot of the CLO world is breathing pretty rarefied air in terms of valuations. Do you think this creates an opportunity to outperform and really pick the wheat over the chaff? Where, okay, if the next 3 years CLOs perform well, but it's not like the previous 3 years where CLOs just crush everything else in fixed income for a variety of macroeconomic reasons. And it really does pay to do security selection, protecting not only against defaults but against buying something at 101 and then you get paid back 100 because you got refinance and all these stuff in the weeds. So yeah, just tell us about you know your outlook over the next, let's say over the next year, as well as how you plan on outperforming the entire CLO universe, or attempting to outperform by your process, and why you think the process is going to work.
Well, I think we were quite blessed in the past few years because we were in a rising rate environment. So as a floating rate portfolio manager, you're able to work with what you have. There is a little bit of you're not having to compete. And then let me explain. We know that a duration trade is about it is in the making. To some extent, it's been put on. If you were to buy the 10-year, a few months ago at 470, and it's now at 380, that's a great trade. Nobody's going to take that away from you. If you had entered into mortgages or IG, when the 10-year was at 470, that's brilliant. That's a duration trade. If rates stay where we're at, that's the end of the duration trade, and you're done. We've seen the performance in IG, mortgages, and high yield. So you're done for the year. Are we gonna go much lower in interest rates? Is obviously the question. So when the duration trade is on, it's a fantastic trade, and CLOs are not going to be able to outperform that. We know that, that's just the case. What we do know is that we can add value through security selection. It's a structured product that's a little bit more complex. So there's some bells and whistles along with the whole investment process. We're looking at the asset manager because the CLO is actively managed for a minimum of, I would say, 3 to 5 years. And a CLO is outstanding for 7, 8 years at a minimum. So you have to understand that this is not a quick investment. It is one that is going to live and breathe with market cycles. It is a portfolio that's going to change because it's the underlying portfolio in a CLO is going to change because it's actively managed. Now you say, well, wait a second. That sounds like, uh, you know, does it mean that every single CLO is idiosyncratic? Yes, it is. It is technically a private placement. And as a result, every single CLO is different, has a different portfolio, has a different manager, has a different structure and different documentation. All of those lead to the fact that you should have a specialist who understands the leverage loan and the CLO market in depth, who makes these investment decisions. And when it's done properly, and I think that leads to why we believe security selection is incredibly important, particularly as we take a look at the current market where we were talking about the duration trade. But we know that there is going to be either a soft landing, a no landing, hard landing that's still out there. all of these probabilities of economic slowdown exist over the next 6 months to 12 months. So what we try to do is ensure that we construct the portfolios in a way that allow us to move up and down the cap stack. So when we want to de-risk, we move up. We use triple A's, we use double A's, we use single A's in order to de-risk. When we are taking a look at adding risk, we go the opposite direction. We move down and we go into the single A's and the triple B's for our investment grade strategies. For those that allow it, we go down into the double B's. So what we've been taking a look at is it's hard for us to see spreads going much tighter, whether that's IG, high yield, or even certain aspects of CLOs. We do see higher geopolitical risks. We do see, and we're taking a look at layoffs. That's our canary in the coal mine. We're really trying to see how unemployment changes. We know from the recent remarks by Fed Chairman Powell that he's taking a look and shifting the Fed's focus away from inflation, but to employment. So employment is going to be the next part of where the economy goes and where rates are going to go. And during this moment of what we see as increased levels of, volatility coming up, it does mean that we have to be prepared just from portfolio construction to take advantage of when we think there are buying opportunities.
So there was a time where you were taking on more risk when you thought the CLOs spreads could tighten a lot. Now you think you don't see a lot of room for spreads to tighten at all. And as you write in the piece, you say CLO fundamentals have begun to soften. So explain why you are moving up in credit quality and you're taking less risk. And, might I say you're even a little bit cautious on some of the greater credit risk as well as some CLOs and why you're being very selective.
Yeah, when we talk about fundamental softening, it has to do with the fact that, again, we're part of a credit team, and our credit analysts are following earnings from companies. And so far, earnings have been okay. But when you're taking a look at what companies are saying and parsing through the language, and you're saying, well, what's your outlook going to be like? How do you feel about sales moving forward over the next 3 to 6 months? And in general, there's more cautiousness from companies. And that's translating into what we look at as, again, you know, the higher for longer interest and rate environment we have been in is beginning to take its toll. And we're starting to see, again, it's not that we're seeing employment fall off a cliff, just we're seeing slightly higher levels of claims, just very slowly as we move up. We're not there yet to where we are really concerned. It's just marginal shifts. And as we see these marginal shifts, both in the underlying credit quality of companies, as we take a look at, again, you know, what we see as being sources of volatility over the next few months, all of this kind of combines for us to be an environment where it's important to be nimble. Not that we have any real concerns, but we want to be more nimble. But again, it's not that that's our base case, but we do see that those probabilities exist. And as a result, it's just our experience managing money through the decades has really meant for us, how do you set your portfolios up, for what may come down in the next 6 months? And that's really what we're doing.
So part of the reason you are somewhat cautious, again, I use that word, I don't think you use that word, is because there could be an economic softening. And obviously, when there's an economic softening or even a recession, that hurts credit. Is there also, and this is somewhat wonky, a risk of even if the credit is paid off, if you buy something at $101 and then spreads narrow and then they refinance you, the manager. So when we're talking about active managers, you are an active manager investing in CLO liabilities all the way from AAA all the way down. Although I think a lot of what you do is in that higher rated portion, but mezzanine. And then, but the CLO manager who manages the CLOs and chooses what to buy, chooses which liabilities to issue, they redeem their liability at 100 because spreads have narrowed. Has that been happening? Has that been a risk, not a catastrophic risk by any means, but just a challenge when you buy something at 101 and you get refinanced at $100? It probably doesn't feel great.
Yeah, and I think this is where understanding the structure of CLOs really works. We were very much doing, most of 2023, we're buying AAAs, AAs, further down the cap stack, double Bs. We were just buying a whole lot of stuff at great discount prices. And as we saw the market recover, and we were talking about why is it we've seen this demand for CLOs, and particularly the top part of the cap stack. We have seen demand from banks, insurance companies, ETFs in particular. So when ETFs get inflows, they obviously need to put the money to work. When you have banks that have decided they're tired of losing money in their fixed rate portfolios, when you have insurance companies that want to increase their allocations to CLO because of the great performance CLOs have, as a result, you're looking at this demand, um, from investors. So it's new, and then you have investors like ourselves that are already invested and also getting inflows. So, we're all taking a look at trying to stay invested. And credit has been doing well. As a result, you had again everything being bid up in price and spreads narrowing, whether it was IG OAS, high yield OAS, all of it really went, these spreads went much tighter.
And sorry for those, OAS is option adjusted spread, so just the spread, how much are
Correct.
being paid over treasuries.
Yes. So we're doing this to compare, to floating rate product. So we're trying to say what the spreads may be. So it makes it a little easier to do, a comparison between different asset classes. And as we saw spreads narrowing for all other areas of credit, we're taking a look at CLOs and seeing the same level again. We're seeing spreads becoming much tighter. When spreads, tighten, and what we saw is that so many of these began pricing above par, and there was this demand that, in fact, made it so strong they were buying CLOs above par and at very, very tight spreads or even negative spreads, and that to us was a bit crazy.
Who was buying CLOs at negative spreads?
Our understanding is that there were ETFs that did.
Got it. Okay. Okay.
So they were buying them at negative spreads. Uh, my experience has always been that if somebody's going to pay more for something than it's worth, you sell it to them.
Yes.
And part of what you mentioned is that the reason we sold this paper that was at 101 is because we sold out of it negative spreads. It was callable, and we said that's crazy.
I mean, you could be the CLO manager could refinance you at 100.
At any time. And we said, some of these programs are on top of their game. And they were like, nope, that's it. We're going to go ahead and we're going to either refinance the deal. So they bring the coupons down to, just like you would refinance your mortgage, you get a better rate. So that's one thing that managers were doing, CLO managers. The second is they were resetting terms. So if they felt that they could, it's almost as if you issue a new CLO, but with new terms. So it's as if you said, all of a sudden I can, you know, refinance and get a new 30-year mortgage. So you know that's a reset. And then the third is that we had the underlying leverage loan market was refinancing. So we exited 2023, approximately 40% of the US CLO market was out of its reinvestment period.
Explain what that means out of its reinvestment period.
Yeah, so a CLO when it's issued has typically a 2-year non-call and a 5-year reinvestment period. So the manager is actively trading that portfolio in order to optimize the portfolio from a credit and spread perspective. When it gets out of the reinvestment period, the guidelines are it's time for the CLO to end its life. Is literally what it means. It's not meant to be a vehicle forever. And there are restrictions as to what the manager can do in order to reinvest proceeds. So it literally says the leverage loan is allowed to repay. And that's exactly what happened. What we found in the first half and all the way through August now of 2024 is the underlying leverage loan market said, wait a second, there's massive spread tightening. And companies, realistically, as they should, went and refinanced their debt. That's what they did. Well, for CLOs, they were at the end of their lives. They couldn't participate in the refinancing, so they got repaid. So we've very high levels of, loan repayment in CLOs. And when that happens, it's more advantageous for the CLO to be called. And that's what happened. So we have been finding that what looks like optically that the CLO market is going through an incredibly active year, record levels of primary issuance, record levels of refinancings and resets. But the reality is the size of the CLO market has remained almost unchanged. And that just happens to do with the fact that there isn't enough new leverage loan issuance in order to create CLOs. And that's really only going to happen once we actually see the Federal Reserve cutting interest rates, and companies are going to come back to the market. They're going to get more LBOs, more mergers and acquisitions, and you're going to get companies who are going to say, well, we want to take a look at either refinancing our debt or raising new capital for particular projects, etc. But they're only going to do it in a lower interest rate environment. And high likelihood is that they're going to take a look at doing it in the leveraged loan market because we do anticipate the Federal Reserve, to be much more likely to cut interest rates. So if you want to borrow money, you want to do so in the market where your interest rate is likely to decline over the next year than in the market where you're locked in for a few years.
So a CLO manager, perhaps instructed by the CLO equity tranche, the equity holder,
Right.
would be
That's right.
refinancing these loans. And in the same way, if someone has a 7% mortgage, interest rates collapse, they want to refinance that at a lower rate, but the bank holding that mortgage does not want it. In this time, instead of interest rates going down, its credit spreads have been tightening. So credit has been rallying. And as credit rallies from 300 basis points to 200 basis points, CLOs have been, and the underlying companies of the leveraged loans have been refinancing and taking advantage of that. Which is, I mean, it's always good to be paid back, but when you have a high spread instrument yielding more than current spreads, that's a good thing. And if you get refinanced and then now you're paying the current spread, that's suboptimal, but that's just part of the way it works. So CLO refinancing and leverage loans refinancing have been very high, but newish. It's not newish. It's a lot of refinancing. So Laila, what is it like? When you're watching kind of dramatized Bloomberg articles, and I've been definitely involved in this about the maturity wall for corporate credit, and that for commercial real estate and other things that are having issues refinancing. Perhaps that is a very legitimate concern. But the high yield maturity wall, is it fair to say that maturity wall has been moved out a lot because there's been a tremendous amount of refinancings?
Exactly that. So what we've seen, I mean, high yield, when we talk to our high yield portfolio managers, they were never concerned about the maturity wall. It has to do with the fact, like everybody, in 2020, 2021, they went out and borrowed a whole heck of a lot of debt at really low fixed rates. So high yield companies are, in fact, in absolutely fantastic shape, as well as IG companies. High yield IG countries went and borrowed a whole lot of debt for a really long time at really low rates. Um, so that's been really great for IG and high yield companies. Leverage loan companies, little different. They have had a bit more of a challenge because, in fact, they're more directly impacted by the fact that their borrowing costs increase. Now, many companies had hedged out their borrowing costs, so it wasn't as punitive as you might imagine, and they've been able to uh, you know, take a look at taking advantage of spread compression, that spread tightening we talked about, and refinancing their debt. So that maturity wall has, in fact, continued to be pushed out. Uh, you know, and that's pretty much what we thought was going to happen. And it now, with interest rates looking to decline, it puts these companies at a better position to meet their debt obligations, and again, push out any upcoming maturities even further out.
Earlier, you said that there were some ETFs, perhaps. It's your understanding that there were some ETFs that bought AAA paper above par at a negative spread. So, did you ever do that? And did the VanEck and Pinebridge product that you manage, did that ever do that?
No, it goes against my ethos for it to overpay for something.
Got it. Well, that's something people should be aware of. And in conducting research, I did. There's the VanEck product. I did look into other CLO ETFs, and the inflows into one in particular of them have been enormous. So I can imagine if tens of billions of dollars are rushing into one product, those ETF managers, I mean, they have to do their job. They have to put money to work, and that's why they're paying for stuff that goes against your ethos, overpaying.
It does, but I also think you have to understand that there's, different ways of managing money. And I understand that they maybe felt that they had to go ahead and purchase what was out there. I think I would have maybe made some different decisions, but I also like the fact that I don't have to buy something that's just one rating. We have a different approach, within the ETFs, the ETF that we manage and the strategies that we run. We don't try to just limit ourselves. We like to find opportunities. Relative value can happen, believe it or not, between AAA and AA. Relative value can happen in the investment grade portion of the cap stack. And we work really hard in order to assess relative value and see where we think we can make investments that are going to benefit our investors. And by not limiting ourselves, to just one rating, I think we're able to bring value to our investors, and I think that's one of the reasons why we really worked and really met when we spoke with Van Eck and they spoke with us. We were all very much on the same page with regards to risk management and investment opportunity set. We wanted to make sure that it worked very well for us, and we are not just limited to say one rating.
Got it. And yeah, so you do invest across the rating stack. I now want to ask, how do you think the lower rated tranches of CLOs or the entire structure will perform in various economic scenarios? Let's start with a mild slowdown where there is no recession, but nominal growth declines as inflation falls. Some people will call that a soft landing. Some people will be happy, some people others, but defaults will rise modestly. And then my second question is, what about a recession, capital R recession, that is something like the 2001 recession where the stock market got killed in that scenario, but the underlying recession was moderate or perhaps even mild. So there, in a recession they do pick up. So what about those two scenarios? How far do you think the the impairments will go up the capital stack of the CLOs?
First of all, any kind of loss are really going to be taken by the equity tranche. And it takes so much to see in defaults to even get some sort of dollar loss of principal at the double Bs. It's very, very difficult. So you have to have two things happen. A poor CLO manager, and you also have to have very poor, security selection, portfolio construction. So a few things have to line up. Not to say it doesn't happen, but you have to have a few things line up in order to get a default even at the double B level. So when we take a look at a soft landing scenario, we're not necessarily seeing much happening. Defaults do, our anticipation is that once we include defaults and distressed exchanges, we're going to be seeing that in the leverage loan space, in that 4 to 4.5%, which would be up from say approximately 3.5% now. So we do see it increasing. The historical default level in the leverage loan universe and in high yield has been approximately 3% to put into context. So we are already above that. We're already seeing higher levels of defaults. So there's the official default rate. We've been seeing a lot of distressed exchanges. So when you actually include distressed exchanges, that number right now is approximately 3.5%. The historical default rate in high yield and leverage loans is approximately 3%. We're already above the historicals. And we do anticipate that that number is going to increase to approximately 4 to 4.5%. So we are already in, let's call it a slightly higher default environment. What does this mean for CLOs? Well, managers are doing a really good job. They continue, to construct portfolios that are going to, withstand that. Most managers are able to limit the number of defaults, that they have in a portfolio, and losses ultimately have been contained. So when we look at the debt tranches, we don't see any real risk to the vast majority of transactions in the market. We also don't see a default spike. So even if we were to see a default spike, a la what happened 2008, going up to about 8.5, just north of 8.5%, what happens in a default spike is that you get the default spike, and then the next couple of years you have almost no defaults. Kind of evens it out.
Mhm.
If we were to get a default spike, again, it's going to hit some CLOs, but again, it's not going to hit your debt tranches. It'll hit the equity tranche. So really kind of depends in where the life cycle is in that CLO, the manager, the portfolio, credit selection, etc. So for us, when we see a soft landing scenario, it's pretty much the scenario we have now. We don't see credit spreads, widening significantly. We don't see that the stock market is going to sell off significantly. We maybe kind of bump along for a while. If we find a scenario such as 2001, massive equity sell-off, credit spreads widen. They will absolutely widen. And then we're going to have obviously central banks coming in, and they will obviously be cutting interest rates, and we're going to be in that environment where it's probably a little bit of a risk on rally to some extent, but there's still going to be cautiousness because there will be some fallout from that from both the equity market sell off as well as credit widening sell off. So for us, that's partly one of the reasons we're getting a little bit more cautious. I would say in our portfolio construction, we're not massively looking at adding risk here, but we're not shying away from it either.
So a risk for a CLO holder, the risk to the CLO is, of course, a default. But is it fair to say that also a risk is, if there's a default, you get zero if there's no recovery, but there's a default, then you get the recovery rate 60%, 30%, whatever it is. But sometimes what happens is the loan is distressed, it sells off to 50 cents on the dollar, and then someone else buys it, a private credit firm, because they think they're geniuses. They refinance it at 70 cents, and then so the CLO loses 30 cents on the dollar. So is it fair to say that even more often a risk of an actual default is the CLO, the loan price is pricing in a default, and then you sell it at a loss?
Yeah, that's it. It's known as par loss.
Yeah.
So that certainly is a risk. So what we do is we take a look at, what managers do. Are they able to have a, par gain? Do they trade well? That's certainly part of it. The other is what's the level of par loss that you might have. And to give you an idea, position sizes in a CLO tend to be, 50 basis points, maybe 75. So it's quite diversified. You generally have a handful of positions that are around 1% or even 1.25% of the portfolio. So let's pretend it's 1%, and let's pretend all 5 of your largest position holdings, defaulted. So that's 5% of your portfolio has defaulted. And again, we're using the 50% recovery rate example because it's easy. You've just lost 2.5% of, your underlying portfolio. Now, the distribution to the equity tranche is anywhere between 12 and 15%. Let's use 12. What it means is that the distribution to the equity tranche goes from 12 to 9.5%. It hasn't hurt your debt tranche at all.
Even the lowest rated single B or double B.
Now, even the lowest rated. So let's say you have about 10% subordination to a single B. Again, doesn't touch the subordination, much. A little bit, maybe here or there, but no, it really doesn't do much. So you still have that, and you still have, the excess spread that's being paid to the equity. So that's one of the reasons why CLOs have performed so well over the decades, is because of the structure, because of the fact that a CLO equity does receive this 12 to 15% or more distribution annually, and the fact that below the single B, you've got about 10% subordination. So all of that combined together is the reason why you can have a bit of a default spike, and you're going to be just fine, even at the single B level.
Sounds like you're relatively confident that even at the single B level, the realized losses at the end of the day will not be that high, maybe even negligible. But that doesn't mean that the price of the single B liabilities, which you own, could sell off in the same way.
Correct.
Defaults in high yield have been fine, but in 2022 there was a sell off as implied defaults, the market getting concerned, the market could always sell off. So the market could sell off even though at the end of the day it's going to be paid back.
That's correct. So you can still get, mark-to-market volatility, just as, I think anybody who held U.S. Treasuries or mortgage-backed securities found out, you still have that. So if you have, an increase in interest rates, in our world, gets its floating rate, an increase in spreads, that will lead to lower prices.
And I want to ask you about the importance of liquidity. I know you stress liquidity. It's obvious to me if you are a bank or you are a leveraged fund, an open-ended fund where people can pull their money at any time, you want to own liquid assets because if you're levered 5 to 1 and half of your money, there's a bank run, half of your money goes out the door, you need to sell those assets. If you own illiquid assets that you have to sell in a falling market, that's a disaster, as many banks learned in 2008. However, I was speaking to a CLO investor, and I want to be clear, I don't think he was a CLO manager. He was a owner of equity tranches across the stuff, and he made the point that actually CLOs, the structure of CLOs, it's unlikely or almost impossible for there to be a bank run because they issue 5-year debt and they own 5-year loans. So, they issue 5-year debt. Let's say you buy it, and then he with that money buys 5-year loans. Let's say it's Burger King, and the asset liabilities are matched. In other words, they don't have the problem of Silicon Valley Bank where their deposits could be called overnight and the duration of the assets they own are very long term, and then there's a bank run. So if that's the case, and if that gentleman who I interviewed in, I believe, December of last year was correct, why are you concerned about liquidity?
That's right. He's absolutely correct. So you actually say, the liabilities just kind of matches up to around 7 years, because loans are issued with a 7-year maturity, which is why you have a 5-year reinvestment rate. So your reinvestment period is 5 years, and what it does is that it limits a CLO manager from investing into new longer-term collateral. So it's designed literally to have those loans that were purchased, say, initially, but they have to fit within certain guidelines, allows that to redeem. Those loans redeem, they pay off, the AAAs, they pay off the manager can sell the portfolio in the market and pay off all the debt notes. That is absolutely correct. So you don't have a mark-to-market vehicle. So the equity investor there is absolutely accurate. Now, we're talking about a collateral pool that's liquid, that has a secondary market. What happens when you don't have a liquid collateral pool and you can't sell out of debt? So the value that a CLO manager brings is that when a credit starts to go bad, rather than waiting for it to drop down in price to 70 and selling it, they've done their credit analysis and they're able to say something, either there's going to be a downturn in the sector, let's call it a cyclical sector. We think things are going to actually underperform, or we think that, things are not going to go well for this particular company, whatever it may be. Uh, and as a result, what we're going to do is sell out of it now. So its current price on this is 99 and a half. We're going to sell out of it at 99 and a half. We'll find something else to buy to replace it at a comparable price level. That's what a CLO manager does. They're risk managing. So that's what you're supposed to do. There is an active secondary market in broadly syndicated loans. That's not necessarily the case when you take a look at smaller loan facilities or when you take a look at upper middle market. This could be companies that have, 50 to 75 million in EBITDA. Lower middle market would be, say, 25 to 50 million in EBITDA. That's what you're taking a look at. Who owns the loan made to these companies? Generally, it's a club deal. Generally, it's 3 lenders. If you don't want to own it, you have to convince somebody else, the other 2 parties, to purchase it. If that company is going through difficulties, do you really think they want to buy it? Not really. And so when we take a look at CLO portfolios, one of the things we do is we look to see how much of the portfolio is in what we are going to consider an illiquid portion. Now, some of that is maybe fine, a few percentage, but when we look at the documentation, when we're involved in the primary market, we in fact negotiate to ensure that that exposure to illiquid that illiquid portion of the portfolio is one that is a small amount that we're going to be comfortable with rather than, say, 10% or 15% or 20% of the portfolio. Because imagine if you can't get out of such a large percentage of your portfolio and things go wrong. So we're very much, we're not very comfortable with purchasing portfolios that have large portions which are illiquid.
Illiquid and the BSL, broadly syndicated loan market, that's a loan to Verizon. It's a loan to a giant Royal Caribbean cruise line. It's a loan to Burger
Yes, for
King. But
example.
then we're talking about middle market, which I think is pretty similar to private credit, where a private equity firm has bundled together, 10 yoga studios into a roll up, and they've borrowed money. Perhaps another private equity firm that has a private credit arm has done that loan. If that's packaged into a CLO, that's what you don't feel comfortable with, because if the yoga studio loan, you're not so confident in the credit quality, the CLO manager has trouble selling it. It's they basically, the market for it is
Can't
the
get out
other
of it.
three people who made the loan.
Correct. And the more you have of this illiquid portion of the market, the more difficult I think it's going to be to try to reduce your exposure because you can't get out of it. We find this with CRE CLOs. Again, highly concentrated portfolios, all in commercial real estate. It feels, that it doesn't give me a whole lot of comfort because, as we know, commercial real estate's not exactly the most liquid. When things go wrong, they can go very wrong. I find that that is the same case with regards to private credit or middle market or direct lending CLOs. They come in various different names. Very difficult to say one size fits all. But it ultimately comes down to how liquid is the portfolio.
Do you have some concerns, Laila, about the rise of middle market CLOs or middle market loans, private credit loans, direct lending loans, loans to more speculative, much less investment grade, and much smaller and much less liquid market for the debt to them? Companies where 10 years ago the middle market CLOs existed, but they weren't that big. But it's my understanding that that field has grown enormously, especially, as we all know, as we are in the golden age of private credit.
Yeah, in and of itself, when you invest and I'm going to say you're going to buy, you're drinking the Kool-Aid of that team. You want to make sure that when you give money to a direct lending, middle market, private credit, you take a look at that team's track record. You take a look and see, what is their track record in that space? If you've got something, a team that's been doing it 10, 15, 20, 25, 30 years, they've got the networks, they've got the underwriting, they have the ability to structure the documentation and the covenants such that they're going to be in an advantageous position when things go wrong. They have a workout team. There's a variety of different ways to get comfortable. Those teams I don't have real worries with. But as we know, whenever we start to see a hot sector and there's a lot of money goes to it, things generally don't always work out so well because you also have teams and businesses, that are put together because they want to take advantage of the ease of raising money to be deployed in the sector. And it doesn't mean that you always get the right teams or the right people or the right firm. And I am sure that what you'll find, whenever you see a bit of a mad rush to get into a new sector and raise money, you're going to find that it's going to underperform at some point. We
Mhm.
recognize it's going to creep in maybe a little bit. Second liens, it can creep in a variety of different ways. We understand that the manager may want to go ahead and add a little bit of juice to the portfolio. We understand that. Depending on the manager, they're going to express it in a few different ways. There are some managers that do it brilliantly. They do it such a good job. Their credit selection, the opportunities that they have to them. They have the networks, they have the connections. They can do that really well. And others do it. It's a miserable process, um, and you can really see that in the performance.
What are your thoughts on? I mean, I'm only reading the articles about so-called creditor on creditor violence, where one lender owns a first lien, i.e., senior to everyone else. In case there's a default, they get paid first, a first lien loan, and then a private credit firm comes in, makes a new loan to that company, and goes on top of them, perhaps taking advantage of the weaker documentation, weaker covenants. How much has that impacted your world of collateralized loans?
Yeah, it's definitely impacted CLOs. A lot of CLOs couldn't participate, in those negotiations. So we've in fact had changes to our documentation such that CLO managers could participate in these negotiations. When a company was doing poorly, we now have situations where you get what's known as a co-op, and that can be problematic. So we make decisions as a firm as to whether or not we're going to stay in a credit and participate with the negotiations. But if it's a small position for us, we just sell out of it. It's not worth it. The risk to us is too big. If we have a large position and we can, be part of the negotiations and sit at the table, that's something else. That's literally what you hear across the entire market. You have to be large enough to be able to participate. You have to make sure you get in to these working groups as early as possible, and you have to make sure that you are able to defend your interests as an investor.
So in that way, private credit is in some way, taking a slice of the pizza away from CLO investors. But in one other very important regard, I believe private credit has benefited CLO investors because they're refinancing the riskiest deals. If I'm not saying whether it is or not, but if private credit is a bubble, has the CLO world been a beneficiary of the money that's flooded into the asset classes, refinancing the riskiest deals out of the CLOs?
Absolutely. It used to be we would say that as a company, you had options to take a look at the high yield market and the leverage loan market. So you needed to know what was going on in the CLO market in order to understand the technicals in the leverage loan market. Now with private credit, a company has three different venues avenues in order to borrow money, and each one has their positives and negatives. So for a company, borrowing in the private credit market may in fact be the best way. There's so much money that has been raised for private credit, it's got to be put to work. That means that the higher yields that you were seeing in private credit are now being compressed down to what you see, in the BSL market. So that advantage may simply be that you're not getting mark to market. You don't have to deal with, a ton of institutional investors. You only have to deal with, a handful of investors in your private credit loan. That, in fact, works out for a lot of companies. I don't know if it works out ultimately for end investors, but it does work out for the companies.
Layla, it's been a pleasure getting a chance to hear your views on CLOs. You really do know the asset class inside and out. People can find out more about your work at pinebridge.com and check out the portfolios that you manage, as well as the portfolio that you and Van Eck work on together. And Layla, my final question is: when you're selecting CLOs to invest in, what are the red flags? What are the characteristics or the actions of the CLOs that you wish to avoid? And let's say there is a mild to moderate credit cycle, and you look back and say, "Oh, I'm so glad I invested in the CLOs that I invested in, because the CLOs that I didn't invest in, we avoided, they had encountered some issues X, Y, and Z." Why did they encounter those issues, and why are you trying to avoid those types of CLOs?
So without a doubt, the experience of the CLO manager is key. So we do take a look at their track record through all the various different cycles, and really understanding their risk management. What do they do when things go wrong? That's always the question. What do they do? Their portfolio construction, their security selection. That's actually quite important. Two, how much of that portfolio is illiquid? It really is something we look at. Um, Three, we take a look at how aggressive the portfolio manager is. Believe it or not, there are some aggressive portfolios out there, a bit more punchy. They are really looking for higher distributions to the equity tranche. Unless we're really good at that, we do sometimes different market environments, we shy away from them, really focusing much more at the top part of the cap stack rather than, say, the double Bs. This is despite the fact that I feel very comfortable with double Bs in general. I would put my entire pension in double Bs, if I could. But when we have, mark to market, we do have, a benchmark return every single month, and we do want to make sure that we outperform. And as a result, what we do try and do is ensure that we are constructing portfolios that measure the market that we're currently in and the one we think we're going to be in. But the red flags always have to do with the track record of the CLO manager, the portfolio. So through that credit underwriting of the portfolio, we're able to determine how comfortable we are with that portfolio. And lastly, it has to do with that portion of the portfolio that's liquid.
Laila, thank you so much for joining us. It's been an absolute pleasure, and thank you to Van Eck for sponsoring this and making this happen. And I just want to say to the audience that this episode is actually going to be one of the last episodes of Forward Guidance that I will host. I will be moving on to a new media venture, and if people want to follow me and the work that I'll be doing, they can follow me on Twitter at JackFarley96. And they should expect me to hopefully be hearing from me relatively soon. Thank you, Laila, and thanks everyone for watching.
Thank you, Jack.
As you just heard me say, this is one of the final Forward Guidance episodes that I will host. But I've got great news. Felix Javin, current host of the On the Margin podcast, is taking over. Felix is not just a great podcast host, but also a very talented trader as well. And he follows the macroeconomic and central banking news like a hawk, or should I say a dove. I truly am resting easy knowing that the future of Forward Guidance is bright and that I have passed it along onto a worthy successor who has all the skills that I do possess and many that I do not. I truly am very excited to see where Felix takes the show. I also will be returning to the world of financial interviewing quite soon. Follow my new YouTube channel, Monetary Matters, to stay tuned with my upcoming work, which you can expect to see shortly. And lastly, thank you again to everyone who has ever watched my work. I'm very grateful to Blockworks and to Van Eck for taking a bet on me. To you, the audience, who has stuck with me over 400 episodes, from the bottom of my heart, thank you so much for allowing me to do what I love.